Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. And I'd just like to take a moment to thank everyone for their wonderful feedback. I get some great feedback on the podcast. It's true that I do put a lot of effort and thought into it, but I very much enjoy it. I guess it's like many things in life that we enjoy. There's a yin and a yang, there's a positive and a negative. So sometimes I do lament having to think up of a new idea or so forth, but I think that discipline of doing every week forces me to think deeply about some of these things. Anyway, I just wanted to say thank you so much. And of course, please share it. I mean, if you know of anyone that might benefit from listening to the podcast, of course, it'd be great if you could share it, help them, and it would help me. Okay, so today I would like to talk about property data. And the reason I wanted to record an episode like this is that more and more I see businesses posting on social media about their approach to asset selection. So that is obviously selecting the best investment asset for their clients. And there's two observations. Firstly, sometimes they put a lot of statistics around it. And then secondly, they tend to advertise quite short-term returns. Bought this property 4 years ago, bank just valued it, here's the capital growth, which is great, by the way. But I mean, no one's going to dislike some early capital growth early on in the ownership period, but it's really about that long-term growth, of course, as I keep talking about. Now, with respect to the data, my concern is, great, data is useful, but only to a certain extent. And data alone will invite you to make a mistake. See, the difference in the share market is that there's an abundance of data really in the share market, and it's real time. I can see what the price discovery, so that is, what buying and selling was done on a particular index or a particular stock yesterday. I can filter that data. It's very sort of sound and real time and really does give us a good indication of fair market value for a particular asset, whether it's in line with its intrinsic value or technical value. I mean, that's another question, of course, but there's no doubting what the market thinks because, lots of people bought and sold that particular stock yesterday and that's what they decided it was worth. Unfortunately, with property, that's not the case. Now, the main providers of property data are the Australian Bureau of Statistics, CoreLogic, Domain, SQM Research, and the Real Estate Institute of Australia and its state-based organisations, Revy and so forth. That's really where, they're providing most of the data around property prices, median values, rents, and those sorts of things. Now, Terry Ryder wrote an article a few years ago just citing an example, say in 2016 for that particular calendar year. The ABS reported that the median house value in Australia appreciated by 3.3%. SQM reckoned it increased by 7.5%. Domain was 10.7% and CoreLogic was 16.7%. So what happened in 2016 was somewhere between 3 and 16%. Now, of course, the reason we've got that variations is that they use different methodologies in order to calculate this. But really what we're trying to do is ascertain the same thing, right? We're trying to get a measure of how has the property market done from a median price perspective. So as I said, they all use different methodologies, right? So CoreLogic, for example, uses a hedonic home value index, which uses regression analysis, looking at all property attributes like things like land size, bedrooms, dwelling type, those sorts of things. And then it tries to value all properties and then creates an index and therefore measures the change in price from that index. SQM uses asking prices. Domain uses settlement data and then statistically adjusts for, if there's been a different or a predominant type of property sold in a particular location. Australian Bureau of Statistics uses data from titles offices and data reported by real estate agents, and REIA uses the real estate agents and then verifies that with the titles office data and those sorts of things. I've always used the Real Estate Institute of Australia's numbers because I think they're probably more reliable, and it does take an approach that audits that data. And I'm not going to say it's perfect. I'm not sure we could ever say any data is perfect, but to my mind, it's kind of the best to use. But the point of explaining this is not to criticize the different approaches because they all have their own pros and cons, but just to illustrate how much variation there is between approaches of measuring this sort of data. And that's why we can't take it as gospel. If CoreLogic says this suburb has performed like this, we can't say, well, absolutely, that's exactly what's happened. Now, that commentary applies to lots of different measures, particularly capital city prices. And I think capital city data is statistically reliable because it includes hundreds, possibly thousands of different transactions. And so it's a lot of data points, and I think that gives us a reliable indication of how a particular capital city has performed over a period of time. Sometimes I'm asked about suburb-level data, how useful can that be? And I have some concerns. Firstly, if you've got a thinly traded or a very small suburb, there just might not be enough sales to give you a reliable indication about what's going on in that suburb. And if you have a fewer number of sales, that they don't always, every sale doesn't necessarily reflect technical value or intrinsic value, which I'll talk about in a second. So that can be a concern. And then secondly, you might have a suburb where you wouldn't invest in maybe 70% of it, but it has a small pocket in that suburb that is investment grade. Well, in that situation, when you look at median prices, it's not necessarily going to reflect, what you could potentially achieve in terms of future investment returns from that perspective. I just think suburb data is pretty limited in terms of its application. Whereas if you compare that to, say, the stock market, well, I can filter stock market value on many attributes, things like leverage and profitability and cash flow of a company's size, or the liquidity of a particular stock. And then that helps me exclude, parts of the market that I might think, well, that's not what I'm interested in from an investor's perspective. And then I can look at the returns data from that. Whereas with property data, regardless of quality, the data has the same weight. So I've got an investment grade property and it's been bought and sold for X. And then I've got a property that is so far away from investment grade and it's been bought and sold for X. And both those sales hold exactly the same weight when looking at growth. Now, that's fine because if the aim is just to measure the property growth in a particular location, but it means it's got limitations from an investment decision perspective. Now, what might be useful is if one of these data providers constructed a investment grade property index, for instance, and maybe what they could do is they could exclude properties that have attributes that suggest the property isn't investment grade, maybe things like the property is located on a busy main road, or it's next to a commercial building or something like that. That'd be kind of interesting. Again, I don't know how reliable that data would be, but I've often thought that I'd love to look at a particular suburb, identify all the properties that I would invest in that suburb, and then backtrack capital growth just from that selection. It'd be interesting to see what the data told me compared to then, maybe a suburb that's, 30 k's from the CBD. These are the things that I waste my time thinking about, but, I don't think we'll ever get there. But that'd be kind of interesting to see that data analysis, I think. So my approach, I use capital city data to give me a broad impression of the trends that might be happening in particular locations and that might have happened over the past in particular locations. And, I've done a lot of work on that. But when it comes to making investment decisions, asset selection investment decisions, I really drill down and have a look at individual property sales data. I don't look at suburb data at all. I never have. So, for example, if I'm looking at buying 14 Smith Street, well, then I'm going to start by investigating all the comparable properties on Smith Street to see how they have performed. And I'll go back and have a look at, what they've been bought and sold for, calculate the compounding capital growth, and start to build a bit of a data set or a bit of a story around, what that particular location has delivered in terms of historic capital growth. Now, the reality is, however, that not every sale is going to fairly represent technical or intrinsic value. And there could be a bunch of reasons for that, which I'm about to jump into. Well, my first observation is that a sale can be heavily impacted by the effectiveness of the sales campaign. So, for example, I could have a fantastic quality property, but if I choose a very lazy real estate agent to sell that property that does a very, very poor job at marketing it, it's possible that I will end up selling for a price lower than what that property is really worth. And conversely, if I have a property that has some impairments, but I hire the best real estate agent in the city and they do a fantastic job at marketing it and mitigating some of the negativities with the property, it's entirely possible that I'll walk away with maybe more money than I should have expected just from that outcome. And I've spoken about, the importance of choosing the right agent when you're selling a property and having the right approach and campaign. All those decisions are incredibly important and tend to have an impact on the end result. It's not guaranteed, of course. Markets can do strange things, but you give yourself the best opportunity if that's the case. So it's important to keep that in mind because that can actually impact data. The next thing is if you have a motivated purchaser or a motivated vendor. So if you've got a vendor that absolutely must sell, maybe they're in financial strife, well, it's quite possible they'll be willing to accept a lower price just in order to secure a very quick sale. So that's a possibility. Or you can have a motivated purchaser. So someone that sees special value. So that property might be worth more to them for whatever particular reason, maybe because they're close to family or they've got the adjoining property or so forth. And that purchaser might be willing to pay over the odds for that property just to get into it, just to buy that property. And I remember a sale in a Melbourne suburb a couple of years ago. This property sold and it sold for way more than what I thought it was going to sell for. And it was a bit puzzling until we found out that the successful purchaser, was not only very, very wealthy, so it was just a rounding error for them, but also they owned the property next door. So sometimes these things happen and, you've got to be careful about relying on data if you don't really know what's happened or, if there's been a motivation by the purchaser or seller. The next thing to consider in the overall data is the fact that 2/3 of property buyers are owner-occupiers. Now, again, if I compare to the share market, in the share market, you can probably fairly assume that virtually all the transactions are purely motivated by financial gain. So someone's selling a stock because they think it's overvalued, or someone's buying a stock because they think it's undervalued and the future returns are going to be good. That's their only mechanism. And if we can make an assumption that you've got a rational buyer, then we can bring the financial analysis to that in order to sort of work out, okay, what's going on in this market. The problem with property is that the motivation isn't always just financial. In fact, with owner-occupiers, I would argue in most situations, the lifestyle and emotional factors play a more significant role in their decision making. And so a family might like to get into a particular area because it's in a particular school zone, and they're very, very keen in order to do that. And they might think, well, overpaying 10, 15%, no big deal. If I'm going to live in that area for 20 years and I want to get in there because it's close to the school we want to use or family or those sorts of things. So you can't assume every transaction in a property market is rational. I guess that's what I'm trying to say. And I think this is one of the big things that economists neglect, when they do their analysis. I mean, you might recall all the big banks agreed that, when COVID hit, that they predicted property prices would drop 20%. Well, of course they were wrong because, there's an emotional element here. 2/3 of buyers, owner-occupiers, there's an emotional element here. No one wants to lose their home, right? So there's not going to be any mass selling in that regard. And I think bringing those sort of emotional aspects or what's called behavioural finance is really important. I think that's the bit that's missing with economic commentary. And the last thing is capital improvements. We need to make an adjustment for the fact that if someone has bought a property, then improved the property, so renovation, extension, but some significant improvement. And I'm not really talking about cosmetic stuff. That's kind of expected, but I'm saying they've changed the nature of the asset. So they've improved it and then they've sold it. If we just look at what they bought it for and what they sold it for, without adjusting for the fact that they've put some money into the property, it's going to overstate the capital growth rate. And what we as investors are most interested in is how has the value of the underlying land in a particular location changed over time, not necessarily, how much capital improvement has been made. So if I'm looking at a particular property, again, I'm using an example, I'm looking at 14 Smith Street, and I look next door at number 16 Smith Street, and I see that it's been bought and sold, but the people renovated during the ownership period, I'm going to need to make an adjustment for that. And so in order to do that, you need to identify when that potential renovation was made and then guesstimate the cost associated with that renovation. Now, it's not a perfect science, of course. We are guessing these sorts of things, but not making an adjustment is going to skew capital growth rates. And in the blog on the website, I've got a link to an Excel spreadsheet that you can use. It's a very simple formula, but for those people that want to know how to work it out, I've given you an example of, and you can plug in your own figures of, how to calculate, well, I bought this property in '07, then I renovated in '09, and then I sold it in '24. What's my compounding capital growth rate? Allowing for the fact that I put some more money into it as a result of that renovation. Now, of course, the capital improvement argument is true even at median house price level as well. So when we look at, how has the median house price changed in Sydney over the last 40 years, of course, a contribution to that change will be capital improvements, because if we have a look back 40 years ago, the average dwelling size would have been a lot smaller, whereas today, if you build a brand new dwelling, you're building almost to the perimeter of the block, having a relatively small backyard, but 4-bedroom home, study, etc., much more accommodation. So, of course, that has contributed to it as well, and it'd be great if we could build an index that dealt with that. I don't know how you do that, by the way, of course. I don't think it's possible, but it's something we've got to keep in the back of our mind. And again, if you're looking at a particular area or location or suburb, as I said, I don't use suburb data, but if you are, and a lot of capital improvement has gone into that suburb, then you need to realize, okay, well, maybe it hasn't delivered 10% compounding growth over the last 10 years. There's been a lot of capital growth. Maybe it's somewhere closer to 8 or less. I don't know. You've got to just sort of make a notional adjustment there. That's why I like to look at individual property sales. Adjusting for these sorts of things, it's really difficult. How do you know who marketed the property and whether the agent was any good? How do you know if the vendor was motivated? How do you know, any of those sorts of things that I've just spoken about? Well, I'm going to wrap it up in the end, but that's why I'm saying data only gets you part of the way. Before I get to that, I just want to talk about other data that's used to sort of justify property investment decisions, and that's demographic data. So sometimes I see people talking about a particular location and saying, well, average income size is this, or population growth in this particular location is this, and using that to sort of justify, well, this is why we think this location is good. Now, demographic data is good, but the first thing we need to think about, is it a leading indicator or is it a lagging indicator? And the problem with a lot of demographic data is it tends to be old. It's very difficult to get real-time data on what's going on in a particular area. A lot of it comes out of census data and those sorts of things, but, it can be up to 6 months to 4 years old, for instance. And then sometimes, a lagging indicator is something that tells you, what confirms an existing trend, whereas a leading indicator will give you a hint to what the future trend might be. Well, as investors, we want a leading indicator, and I would argue there's not many good, reliable leading indicators that are going to tell me, what might happen to a particular geographical location from a property perspective. So that would be my first observation. My second observation is that, do you really need that demographic data, or do you need to consider the demographic characteristics of a particular location? Because shouldn't the attributes, so the positives or negatives of that data, be reflected in the historic capital growth rate? So that's my view, is I would much rather say, well, this area has generated, really strong growth over the last 30 years. To me, that's the most compelling evidence that that location is investable. Whereas if I'm going to an area where there's no such evidence, then I'm really putting a lot of reliance on this demographic data. Now, it could be right, but it's a higher risk strategy, and I don't like to take risk. In fact, I think successful investing is about taking the lowest risk and achieving the highest return. Okay, so what do I think about data then? I guess I can summarize it by saying I think data is important, and I'm an analytical person by nature, so I like that data. I certainly look at past sales, all those sorts of things. But data is only going to get you 50% of the way there. The other 50% is that local area knowledge. The knowledge to know we're going to disregard that sale because we don't think it fairly reflects intrinsic value, whether it's a good sale or a bad sale, high sale or low sale. Either way, we're going to take that approach because we know the area that we're buying in. Whereas if you're using a buyer's agent, for instance, that doesn't have any local area knowledge, it's very risky because they might be too guided by the data and they might not necessarily know the story behind that particular data. So I think looking at suburb and capital city data is kind of interesting just from an overall sort of perspective of seeing where a market might be at. But if we're going to make investment asset selection investment decisions, I think it's very important to drill down to the particular location that you're investing in, and to the point where you might even just only look at comparable sales on one side of the street. If there's an impairment on the other side of the street, and sometimes that happens. So let's say the southern side doesn't really work, but the northern side is investable, then just look at comparable sales on the northern side, and you can start to build a bit of a data set and a bit of a story around that to give you confidence about what future investment returns might be. All right, let's get into some listener questions, and I got some good ones today. Of course, I'm always say that. I think they're always thought-provoking. Okay, so this one is from Jaden. Gives me some great feedback on the podcast. Thanks so much for taking the time to share that feedback, Jaden. Anyway, Jaden writes, you mentioned how industry super funds become less ideal when the balances are over 500,000, and beyond that balance, you recommend a wrap platform. Do you have a similar figure when you recommend owning shares in a trust or company? At what point does there become a sweet spot for owning shares under a trust or investment company in terms of account balance size or annual income of the individual? Could you also explain the process that you need to go through to move the shares from your personal name into a different investment structure, and when that is appropriate to do so? A bit of personal background Jaden he provides. I'm 24, currently have around 65,000 ETF portfolio, and I'm studying to become an airline pilot. I have looked at what role I want as an airline pilot in the future and the expected salary I will earn, and that will push me into the top tax bracket. I intend to invest large amounts into a share portfolio over my lifetime with a goal to surpass $1 million. I can't help thinking that sometime down the investment journey in the future, I'll have to change the ownership structure or pay higher taxes. Okay, awesome question, Jaden. There's quite a bit in there. So Jaden mentioned that I suggest that, maybe an industry fund isn't the best place for you if your balance is over $500,000. And the reason that I recommended or suggested that, not really a recommendation because nothing in this podcast is personal advice, of course, but the reason I made that observation is that because of the percentage-based fees. So really the higher your balance is, the more sort of fixed fees or fees that max out don't just continue as percentages, the better off you'll be, because, if you're paying 0.5% on a balance of $5,000, no big deal. But if you've got $1.5 million in there, well, it really starts to add up in terms of dollar value fees. So that was the observation there. Now, when it comes to investing outside of super and whether to do that in your personal name, in a family trust or in a company, it really does depend on your situation. And that's really the benefit of, we put some long-term projections together when we develop a plan. So we can see or measure, if we do take these steps and implement this plan, what will the portfolio value be in, say, 10 years' time, and how much will the unrealized gains be, and how much is the taxable income coming off that portfolio, and then again in 15 years and 20 years, and then we can try and sort of measure it out. We have to sort of be conservative. I don't want to be in a situation where it sort of feels like we're going and just recommending everyone invest in a family trust. I want to have confidence that, if I tell my client to do it, net of costs, that they're going to be better off. And as a result, I think from a advisory perspective, we tend to be a little bit more conservative, and that is lean towards not recommending structures as opposed to recommending structures. But just generally, if I expected my portfolio to be worth $500,000 to $1 million, something in that range, I would start thinking about putting it in an entity from day one. Now, I say 500 to a million, definitely. 500,000, I start to think really carefully about it. If I thought it was 750 in a 10 years' time, the portfolio size, there's an 80% chance I'd probably put it in an entity. So that's why I sort of give you a bit of a range, because it's not perfect. It really does depend on a couple of other, factors which I'll sort of get into. But also, going back to sort of Jaden's question, his situation, he's very young, 24, right? He's going to be a high income earner. He's of a mind to invest in share market on a regular basis. It's very easy to anticipate that his portfolio will exceed $1 million, well exceed $1 million over his lifetime. If I was in Jaden's situation, I'd almost certainly put it in a family trust. And I would acknowledge by doing so, over the next 10 years, I could be worse off. I could be, not majorly, like it's not going to be life-changing, but, it could be cheaper to keep it outside of an entity. But I know over my lifetime, almost certainly it's going to be better off. I mean, having money in a trust, for instance, for Jaden, if his spouse is on a lower income, assuming he gets married or has a de facto relationship, if his spouse is on a lower income, he can distribute some income, the investment income, to his spouse. If they've got adult children and not working, so that is, going to uni and so forth, can distribute to them, can distribute to grandchildren, can distribute to a company and cap the tax rate at 30% on any investment income and get a credit for the tax through imputation credits. Can even up distributions between him and his spouse, so, in the long run when he's retired, he can make sure that he's utilising both tax brackets as efficiently as possible. And then there's some estate planning benefits and, in terms of passing on wealth, all those sorts of things. Now, if setting up a trust costs you $2,000 a year for the next 40 years, that's $80,000. It's really not hard to see you save $80,000 in terms of from tax and all the other benefits of having a trust. So it's really difficult for me, for an advisor, to tell Jaden that's 24, you should go and set up a trust, because there's the immediate benefit isn't obvious. So you'd actually have to, in that situation, tell him not to do so. But if I was in Jaden's shoes, I would take a very long-term view and say it's a no-brainer. I would go 99%. If I was in his shoes, I would absolutely go set up a trust, right? But that's why it's a great question. And, having that perspective and taking those long-term financial decisions is something that I really talk about a lot. Now, the second part to Jaden's question is how do you transfer those shares into an entity? So maybe I'll just explain, because it happens quite often with clients. We meet clients, they've got investment assets in the wrong ownership structure, or we might think they're the wrong ownership structure. We will consider the amount of unrealized capital gains, because that's your problem, right? If you're going to move a share portfolio that's in your personal name into a family trust, it's going to trigger capital gains tax because there's a change of beneficial ownership there. So we would consider capital gains tax. If we thought the capital gains tax was prohibitive, then we probably wouldn't do it. Or what we might do is just gradually move, parcels of shares across each year, but just try and manage or spread out that capital gains tax liability. We have at times when markets have dropped. So, for example, in March 2020, when COVID hit, everyone will know the market dropped significantly. With a couple of clients, we moved share portfolios at that time because the capital gains were much lower. So sometimes a little bit of market volatility can sort of play your way in order to be able to do that. Certainly with new investments, we'd put them in the right structure. So our approach would be to say, yeah, you've got this share portfolio, it's in your personal name. We wouldn't have done it that way. Let's keep investing in shares. Let's establish a family trust and then look for opportunities from year to year to start moving some of those assets across from your personal name into the family trust. And we would try and do that over time, knowing that we might not ever get to zero. We might not be ever successful in moving everything, but that's kind of the approach. Not perfect, and that's why I say if I was in Jaden's situation, I would almost certainly get the structure right first. The fees probably aren't going to change your life, but at least when you look back in 20 or 30 years from now, you'll be glad for making that decision, I think. Okay, that's it for me for this week. As I said, if you know of anyone that would enjoy the podcast, or if you want to leave a rating on the platform that you listened to this on, that would be fantastic and I'd greatly appreciate it. Thanks, guys, and until next week, bye for now.